Hello and welcome into the KE Report. I'm your host, Shad Markwitz, and we're getting an update today from SURG Copper, traded on the TSX.V under the ticker SURG, and on the OTCQB under the ticker SRGXF. And we're talking today and joined with the CEO and director of SURG Copper, Leif Nilsson. And Leif, we just had a nice meeting in Washington, D.C. earlier in the month where I sat down and revisited it. We were laughing that we hadn't even had you on the show for a year, and so I was a little rusty just on how things were going on the projects and came away from the meeting very encouraged, enough so that in full disclosure, I am a shareholder now of Surge Copper. But in a market with an appetite looking for copper development stories, I do think the Surge Copper story is unique. And you have two projects, the Berg Project and the UTSA property. And the last time we had you on the show, really last summer, we were talking about and breaking down the PEA, the preliminary economic assessment that your company put out on the Berg project. And this is a project that has copper, molybdenum, gold, and silver. So it's kind of a polymetallic project. Why don't we start there, Leif, and just kick things off for people listening in with what are the resources at the Berg project and maybe the key takeaways from the economic study you put out a year ago?
Sure. Yeah, absolutely. So this came out in June of 2023, as you mentioned. I think importantly, it is a maiden economic study, meaning the first time that there's ever been one done to 43101 standards and put into the public market. The Berg deposit has a longer history than that. It's been kind of known and operated by a bunch of different companies over the years who sunk various investments into drilling and metallurgical test work and what have you. But prior to us gaining control of the asset, the most recent prior handful of companies that owned and operated it got a hold of it through M&A transactions involving portfolios or baskets of assets. So this was always kind of second or third string for them, and there wasn't a huge amount of focus on it. So I'd say before we got involved in the Berg project, it had sat there dormant for a number of decades. So we were quite excited in 2020 to get a hold of it and start working on it. And the work that led up to that PEA was, involved a bunch of trade-off studies, a bunch of new drilling, reassaying of old core, and really thinking about it with a fresh lens, given that we have other assets in the district and are trying to look at this district from a fresh perspective. So when we put that out in June of last year, it did come with an updated resource. So at a very high level, it's about 1 billion tons in the measured and indicated categories, and an additional just over 500 million tons in the inferred category. On top of that, in the M&I category, it contains just over 5 billion pounds of copper, just over 600 million pounds of molybdenum, about 150 million ounces of silver, and just under or about 750,000 ounces of gold. Easy or simple explanation of the PEA. It envisioned a simple open pit mining operation that runs for about 30 years. That would produce about 191 million pounds annually of copper equivalent over that 30 years, totaling just under 6 billion pounds of copper equivalent production in total. Economically, we tabled a after-tax NPV at an 8% discount rate of about 2.1 billion Canadian dollars, and that's based on commodity prices of $4 copper, $15 moly, $23 silver, and $1,800 gold. Obviously, all of those are well below where spot prices are today. And then similarly, on an after-tax basis, the IRR was about 20%. So I think the key selling points here are big. It's sort of a large enough project to be strategically significant for a wide range of big multinational mining companies out there. It's in the right commodity mix. It's in a great place in the world in central BC with good infrastructure, good jurisdiction all around, and those high-level economic numbers I mentioned are quite competitive relative to lots of other stuff out there today.
Well, let's dig into it a little bit further. I mean, I think it's an interesting mix of metals, and in particular, you kind of check the box for both precious metals, but also critical minerals and the strategic metals when you have the copper and the molybdenum in there. And so I'm wondering, does that give you any funding advantages having the strategic metals in there like copper and moly? And even to a lesser extent, we're going to need a lot more silver if we want a lot more of the EVs and solar panels, but in particular, the copper and the moly. And then the other thing is, You mentioned that a lot of those metals prices are a lot higher today than they were at the study baseline. You have a really interesting table that goes over the sensitivity. So not just the breakdown of the metals, but also what things look like with the project in today's metals prices.
Yeah, absolutely. So in terms of funding, nuances, given that we are a critical minerals project, it's a great question. Lots of different, programs have been announced at both the Canadian government level and even some international stuff, including in the US, where there's lots of different sort of funding programs that are being planned and rolled out in the coming years for projects that have this sort of characteristic where it's in a place like Canada, it produces, large amounts or potentially produces large amounts of metals that are relevant for both the energy transition stuff, but also lots of other kind of geopolitical trends that we're seeing in the world with regard to friendshoring and things like that. So copper is obviously one of those. It's the quintessential metal in all things electricity. So lots of different end use markets for that have structural deficits for as far as the eye can see, and great supply and demand fundamentals. Molybdenum, not too different, much smaller end market, but it's used in all kinds of specialty steel applications and aerospace, defense, pipelines, onshore wind turbines, et cetera. So very, very interesting end market there, and similarly, very good setup from a supply side. So very run of the mill, right in the middle of the fairway description of a critical minerals project. And as you say, there is a little bit of precious metal byproducts from both silver and gold. The revenue contribution from the precious metals at the metal prices I mentioned is around 11%, with most of that coming from silver. And so, yeah, the funding attributes beyond the potential for things like grants and favorable loan programs for certain parts of, CapEx in a mine build situation. There's also lots of talk around, favorable tax regimes for projects like this in the future, where you might get, accelerated depreciation allowances on certain big pieces of CapEx, things of that nature. More relevant to us today is on the flow-through regime. So for any exploration related investments that we're making today, those qualify in general for flow-through, but there's some additional perks for critical minerals related flow-through. So we occasionally make use of that stuff and do flow-through related offerings. We typically make use of the charity flow-through structure, where I know there's a lot of confusion in the market sometimes around how these financings work, but the way we always look to do them is where the end buyer is a kind of normal, long-term oriented type shareholder, the same types of shareholders that would be buying normal common shares, but you overlay a charity structure on top of that. There's a little bit of financial engineering involved, and that allows you to end up with the same exact shareholders you would otherwise, but you're able to capture this tax incentive and issue stock at a much higher price, and therefore lessen dilution.
Well, let's get into the sensitivity table that you have in your slide deck, and I will include a copy of that sensitivity table below this interview so people can view it. When we were in our meeting together in DC, this really jumped out at me, and that is thinking about copper and gold and silver and molybdenum, where they're at today versus the baseline studies that you had in here. You can just see the upside, especially if something like copper goes back above 5 and then keeps on trekking to, let's say, 6. You can just imagine where this thing is going as far as the internal economics on it. But just walk people through, in a general sense, the sensitivity this project has to higher metals prices.
Yeah, sure. So, I mean, the way these studies are always done is it's kind of a point in time in terms of cost estimation for CapEx and OpEx. And then same thing with currencies. These are all done in sort of on a real basis using 2023 dollars in our case. So yes, a year has gone by. And so when you look at the metal price assumptions we used, which implicitly are conceptually like a 30-year flat price deck of whatever those prices that I mentioned are. So the NPV number assumes, $4 per pound copper in 2023 dollars for 30 years into the future. So it's anyone's kind of guess what a 30-year average will be, but certainly where we are today, I think with spot prices being higher than those levels, and I think a lot of the supply and demand dynamics around these metals certainly improving from a pricing perspective. I certainly think those sensitivity tables can shed some light on that. So yeah, if you were to look at where the spot prices are today and make no other changes to CapEx and OpEx in terms of those 2023 estimates, you're looking at $3 billion NPV numbers and IRRs kind of in the 24 to 25% range. But again, that's must be taken with a grain of salt that it's not the sort of base case numbers that we highlighted.
Yeah, I just think it's an interesting point, and this is true of any project, that obviously the higher the metal price, the more economic it looks. But because you are so leveraged to copper and even the molybdenum prices, then it's just a nice kicker that the company has if we start seeing the kind of copper prices that many analysts are predicting, where they think it's going far north of $5. Just something to keep in mind as far as the optionality that the project has to even more improved economics over time. Another thing about the resource size is if you add in the Berg project and your UTSA project together, it's a pretty formidable copper resource in Canada. So maybe just speak to how it stacks up in the sector as far as people looking for copper in Canada. How does SURG fit into the mix?
Yeah, I mean, it's going to be one of the largest resource inventories in Canada. We've got a graphic in our presentation that highlights that. Of course, a lot of the other big deposits are active mines today that are net of a bunch of depletion. But where things sit today from the landscape of development stage projects, if you look at that on an M&I basis, like we're definitely in the top few projects from a Canadian perspective. So absolutely, it's I think an uncontroversial thing to say that if you're kind of interested in development stage North American located copper porphyry resource inventories, SURG has control. I mean, 100% ownership over one of the largest resource inventories out there.
Well, and that brings up the interesting topic of mergers and acquisitions in the copper space. We've seen, Leif, a lot of high-level deals with the big boys, buying other projects from the big boys, mostly going after producing assets. We haven't really seen a big movement yet to trickle down in development assets. So I guess I'd like to get your thoughts just generally on M&A in the copper space and how that sets up the development stage companies in this coming cycle.
Oh yeah, this is something that excites me, and I've got a background in M&A advisory, so it's something I follow very closely. But I would say in the last 3+ years, in the wider world of mining M&A, copper has been one of the most active areas. And I don't have a full list of transactions in front of me, but I mean, there's just been a lot of deal volume in terms of number of transactions, and then really large value transactions that have taken place over the last several years, with a very dominant theme on copper. The caveat to that, though, is the targets in all of these transactions, almost without exception, have been producing stage assets. So the takeaway from that is that there is a lot of demand among mining companies globally today to get to sort of increase their exposure to copper production in the future. And so, not surprisingly, the first order of business there is to look out into the world at what the opportunity set is and focus on transactable assets that are producing copper today, that are going to give you that kind of near-term cash flow and near-term exposure to the positive evolving copper market that we see. Just sort of, it goes without saying that that pool of targets is not infinite. It will one day run out, where all of the transactions that are available to be done have been done, and there's no more smallish assets out there, or all the mergers have been done. And I think the larger mining companies at that point in time, to the extent that they haven't placed their bets, are going to want to or need to go down into the development stage market. And so there's a lot of good projects out there in the copper space that are all thinking the same thing and heading in that general direction of trying to get their assets in the best possible position for when that window opens. So don't think that window is open today. As I said, we haven't seen really very many at all development stage copper transactions, but perhaps in the coming couple of years we'll start to see that happen. So the thing that's most topical right now is the Rio Tinto Anglo transaction. Anglo, obviously a very large diversified miner with interests in many different commodities, but that particular transaction is very clearly focused on their world-class copper part of their business. even to the extent that the kind of conditional deal proposals are, asking for, looking for everything else that's non-copper to be spun out or sort of dealt with separately. So very obviously the focus on that is the copper production units that can come out of the Anglo portfolio. And the implied valuations are pretty interesting from a comparison perspective when you look at that versus what it costs to build, comparable volumes of, or at least sort of normalized volumes of annual production capacity. When I'm looking at some of the research or editorial comments around the Rio Anglo situation, they're pointing to sort of, what it costs to buy copper production capacity from a portfolio like that. And the numbers are pretty high. It's sort of in the 30 to 35,000 US dollars per ton of annual copper production capacity. And you can compare that to a kind of broad set of development stage projects where on a similar basis to what it would cost you to build those projects and get annual copper production capacity would translate into something in the sort of 20,000 US dollar per ton range. So there are transactions happening today where the price being paid for this is a very simplistic way to look at it, of course, but the price being paid for annual production units is materially higher than what you'd have to pay to build something equivalent. Again, that makes sense. It's a little bit bird in hand because you got assets that are built, they're producing today, as opposed to something that still has a lot of embedded risk and would in theory produce in the future. But nonetheless, I think that's an interesting setup for the coming M&A attractiveness of development stage assets. Again, hopefully in the next couple of years, we'll see the market start to move in that direction.
Yeah, it is an exciting setup in the space for the development stage assets because after the production assets are acquired, it's a very limited pool, as you say. The next thing in the batting order is going to be going after some of the development stage projects that would interest a larger company. And to that point, your company is working on doing a number of de-risking initiatives in the background. You just put out a updated outline of the pre-feasibility technical work that the company is doing, things like metallurgical work, environmental studies, geochem, geotechnical, some other targeting work. Maybe speak to us about some of the work your team is doing behind the scenes as you work towards the pre-feasibility study.
Yeah, absolutely. So as you mentioned, one of our most recent releases, it talks about this funding package that we put forward, and I'll circle back to that in a second. But the objective basically is to advance a number of technical work programs that will bring the underlying physical technical data at the project to a PFS level to get us into a position to crystallize a pre-feasibility study at some point in 2025. If we hope to, or if we're targeting bringing the Berg project to a PFS stage in the 2025 timeframe, the first order of business is getting after a few technical work programs that are going to, advance the project or advance the deposits to that sort of PFS level. And so the things we identified or highlighted were a metallurgical test work program, which is already underway. We're using material that's been drilled in recent seasons for that work, so it's kind of fully scoped and ready to go. So that's underway. When our field season starts later this year, we are going to be doing a wide range of drilling that has lots of different objectives between resource upgrading and conversion, some geotechnical analysis on some of those holes, taking samples for some geochemical analysis to help firm up our assumptions around waste rock and tailings disposal, things like that. And then starting the environmental baseline programs where you need to gather lots of time series data in lots of different areas of the project footprint as you build up towards ultimately entering a permitting process. So it's all pretty exciting stuff given, we're right at that early stage transition from a exploration project into that kind of development stage. So we're getting all that stuff underway this summer. There will be some exploration involved. We've got some interesting targets that are in close proximity to the center of gravity at the resource. So some of the activity will be focused on advancing those, potentially drill testing. So lots of kind of value additive potential will come out of that. And then from a funding perspective, we have announced in April a funding package to fund all of this work. A couple interesting pieces to it. So the first piece was a strategic investment from diversified mining company called ARM, African Rainbow. And then we did a sidecar placement on top of that, just for kind of normal market-based investors. So we've put the funding package in place to fund all that work. That'll carry us into 2025 and should bring the Berg project to that, put us in a position in 2025 to galvanize a PFS, which, in the market context I just talked about, I think is the right place to be, right commodity, right point in time. And a PFS project, I think, is something that will be, increasingly valuable and interesting to a broad audience out there.
All right. Well, a lot of interesting work the company is doing, working towards that PFS, and we'll keep following along with the news out of Surge Copper as you continue to put news out to the market. Keep me posted, Leif, and we'll get you back on the show for an update. And if people listening in want to follow along with the news from Surge Copper, definitely click on the link below this interview. It takes you directly over to the company website, to their news section. And as always, Leif, looking forward to our next conversation.
Likewise. Thanks a lot.